It's a joint work of Adrian Verna and Vincent Morin. And the title of the paper is Can Stablecoins Be Stable? I don't think this particular audience needs much of an introduction or motivation, but we need to start anyway. So what do we mean by stablecoin? So we mean a cryptocurrency that's backed to the value of an official currency, something like typically the US dollar or the euro. And the idea is that you would like to benefit from the blockchain technology, write smart contracts and things like that, but at the same time, you also don't want to be subject to the high fluctuation, the high volatility of the traditional currency. So, and it might be a good reason to try to create these stablecoins. So the stablecoin market valuation grew a lot from around $3 billion when we started working on that around 2019 to something around $125 billion last time we checked. Actually, if you were to look a year earlier, that you would be even larger than that, because in the meantime, one very famous and large stablecoin that people heard about, Terra Luna, actually fell and reduced that figure. For good reasons, therefore, we have seen a lot of regulatory initiative basically all over the world, and these are still ongoing right now. Something that's interesting from a theoretical perspective, from like an economist perspective, that many of these stablecoins have a lot of heterogeneity in their designs, and this heterogeneity spanning different dimensions can be about the governance, about the exact way they are trying to maintain the peg, the issuance mechanisms related to the peg issuance as well, and also the collateral backing, including sometimes some stablecoins that try to maintain the peg without any external collateral at all. So it's a bit of a mystery of how you can design such a thing in the first place. So the goal of this paper is going to be to try to assess what feature the design can help or not the stability of the stablecoins. So at this point in the presentation, you might be wondering, do we really need a new model or a new theory? We have like a lot of good theories about banks and bank runs. And so I'm going to argue here that it's partly correct in the sense that we have the problem that stablecoins are going to solve. It's actually no problem. It's the same problem that many other institutions have been facing for a very long time, including banks, central banks, private banks, and governments to some extent as well. It's basically the idea that whenever you have the authority or the capacity to create money and to generate semi-large revenues from doing that, you always have an incentive to overdo it, because you can create something that costs you maybe a couple of cents to create, and that's worth $1. And so experts, you will always want to create some more. But that's bad news for the ones that actually hold your currency, because you're going to devalue the currency. So ex ante, that's going to create an issue that's anticipated, and then you cannot get or you cannot extract any semi-large revenues. Typically, that earning semi-large revenues require some form of credibility. But of course, we know that in the crypto world, people don't like to rely on credibility, and they think technology and blockchain technology, smart contracts, can go beyond or can replace the credibility of the trust. So this is going to be the main difference about the way stablecoins will think, but stablecoins are different than traditional banks. So we think about it in threefold. There's three main elements. The first element is that stablecoins can rely on smart contracts in order to get some form of commitment. So they can decide at any point in time, exactly, they can tie their hands to as of exactly what they can do in certain situations. And that might help them solving these time consistency problem that I just described. The second reason is that you can also, through this blockchain and Garrigan, you can decentralize the issuance altogether. Maybe that's something that can help you as well. And then the third main difference is that issuing and redeeming tokens is something you can do with this technology for a very low cost. And that means that you might be able to do some form of an open market operation without actually holding some liquid assets on your balance sheet. You'll be able to simply using or creating equity tokens whenever you need to do an open market operation, unlike a bank or a bank tries to maintain foreign exchange peg and then has to also for exchange results. So that's going to be the difference. That's going to be important for stablecoin platforms. So this is the way I'm going to think about what stablecoin platform as a time sheet. On the liability side, you're going to have the stablecoins. On the asset side, you're going to have two main assets. First one that some of these are collateralized, so you can have collateral here that's on the blockchain. And then also, because these stablecoins can generate some future standardized revenues, that means also has some equity in the platform. Then it also means that these future standardized revenues can be used to back up the value of the stablecoin in the first place. And we'll see how that plays out in the construction of what's being called algorithmic stablecoins like Terra Luna. Okay, so this paper, very quickly, we are going to build a model where you have on one side the demand for stablecoin, and the demand for stablecoin is going to be time varying, and it's going to only really be there whenever the stablecoin is actually stable. It's actually maintaining the peg, otherwise it's going to be lost. On the supply side, we are going to model a monopolistic platform that maximizes its future standardized revenues, and that decides on a bunch of policies in order to do. The key friction, as I already mentioned, is going to be this time consistency problem. It's close to this Gaussian conjecture. You always have an ex post incentive to issue too much, and that's an issue because if that's anticipated, then you cannot extract any of the standardized revenues in the first place, because agents wouldn't want to hold it. So by this. Okay, I can preview the results quickly. So we are going to vary the degree of commitments that we allow the platform to have. At the beginning, we're going to assume that we can really write smart contracts on all the state of the world and see what we can get. And in that case, we'll see that how this supply adjustment mechanism will be able to implement some form of local equilibrium where the peg is actually maintained. Basically, the idea is that in order for the price to be always equals to 1, you need that supply and demand always intersect exactly what the price is equal to 1. So if you have a demand shock, the demand goes down, then you need to reduce supply. And the way you reduce supply is by issuing some more equity tokens that you are going to use in order to buy back some of the stablecoin and then put the supply of stablecoin back in line. That's the idea, but we're also going to see that this is fragile. It's only something that's going to work locally because the platform is effectively leveraged. It means it might face some default risk. And then we're going to look at what's going on whenever you have no commitments to this time consistency problem. We're going to see that it's something very problematic for the platform, but decentralization can actually help. And I will be explaining exactly why that's. Okay, so let me move on quickly to the model. So the model is in continuous time. All agents are risk neutral. And the stablecoin is infinity maturity assets that pays an interest rate delta t, and that has a price pt. We have a mass one of users, and they value their consumption, but they also value the stablecoin in their utility function. I'll be more precise. There is going to be a condition I already mentioned. But basically, this is going to give us a competitive stablecoin pricing equation that's on the board here. And really, what matters for us is going to be that we're going to create a demand curve. Don't want to think demand curve, but you can think of as being this marginal utility of holding the stablecoin whenever it's actually paid. And I'm going to call that L. So L is my demand curve. So the flow is the demand function for stablecoin. So I'm going to assume here that L is subject to some exogenous shocks in the form of being indexed to this variable 80. Which I'm going to think about the demand. And it follows the following process that has a geometric Boolean part, but also a jump part. The jump part will be very important in order to generate this trouble that I'm talking about. So from time to time, you're going to have like a very large negative shock. As the peg assumption already mentioned, you only get the utility from holding the stablecoin whenever the stablecoin peg is actually otherwise you don't have it. Okay, let me move on to the centralized case, and I'm going to do the decentralized case later on in the presentation. So the stablecoin platform has to choose 3 policies. The first policy is going to be, at any point in time, you need to decide how much stablecoin you want to issue or you want to redeem. That's the DGT. The second policy is that at any point in time, you need to decide how much interest rate you are paying. That's my delta T. And what's important here is that the way you pay this stablecoin, as we've seen this morning, you just credit the account with a little bit more of the stablecoin. So that's going to drive slow motion for the total quantity of stablecoin, how much you will actually create in that period and how much you need to create in order And then I'm also going to assume that the platform chooses a collateralization ratio, but it only chooses it once at the beginning of the platform, and creates the platform at the beginning. And then from then on, this collateralization ratio is going to determine how much collateral you actually have in your platform. The assumption here is that the collateral is a safe asset, and because it's a safe asset, it will also have some form of convenience yield, in the sense that the return that the collateral asset generates is lower than the discount rate. So there's already like for some form of convenience yield that's embedded. You can think about it as like a T-bill, already has some convenience yield. And then what's important here is that the monopolistic platform will internalize the effect of all these policies on the pricing equation. That's how we're going to get to an equilibrium. Okay, so let me move on and tell you about the full commitment case. So I'm going to assume that the platform can write smart contracts and fully commits all these decisions. And first, I'm going to go even beyond that. I'm going to assume that they have some sort of like unlimited commitment. What I mean by unlimited commitment is that you can always fulfill your promises in all the situations. So there's no form of limited liability here. So you don't need to pledge things explicitly on the platform. Equity can go negative. The idea is that you can commit never to default on your promises. Okay, so in that case, the monopolistic platform actually simplifies to a very simple problem, where we can see that it has to maximize the value of these future annual revenues flows, which is comprised of the liquidity benefit it creates times the quantity of stablecoin outstanding. So you can think about that as being like price times quantities. That's exactly a traditional monopolist problem. You just like maximize the area under the curve minus the collateral cost. And you do that under the pricing equation. So what do we have in that case? Very simple equilibrium. You're going to put zero collateral because you have this unlimited commitment and collateral is costly. So you don't want to waste resources on collateral. You're going to always choose a static quantity of stablecoin as a function of the quantity, as a function of the demand. Basically, you're going to maximize the area under the curve, so that's for a given demand. So that's what you do, like traditional monopolist behavior. And then what happens is that if the demand goes up, then you need to increase the supply as well in order to keep this ratio, this little a, which is the ratio of C to A, always constant. And if the supply of stablecoin goes down, then you need to decrease the quantity. So if the demand goes down, then you need to decrease the quantity of stablecoin so that this ratio always stays constant. And you want to do that, you want to implement it with like some form of open market operation. So now the question is, what if repurchases have to be financed with the wealth in the platform, with things that are already pledged, and you cannot go beyond? There's like some form of limited liability here. So in other words, that equity cannot go to negative territory. Well, when that's the case, first I'm going to consider the case when there is no collateral at all. This extreme case, like an algorithmic stablecoin. So basically the idea is that now, if that's the case, it means that you need to refinance all the stablecoin repurchases by issuing the additional equity tokens. If you do that, then you're going to get in trouble whenever the value of the equity goes to zero. And you can see that by looking at this balance sheet, the platform is always effectively leveraged because the stablecoin are a liability of the platform. So if you have a large shock, the large shock can possibly wipe out the value of the equity. And if you don't have, if the value of the equity is zero, then you can issue as much as you want. You're never going to be able to repurchase. Okay, and so that's going to give us basically an equilibrium where we have two regions. In one region, the bag is going to be lost because your equity is at zero. The value of your equity is at zero. You cannot do these repurchases. And on the other side, you're going to have this jump back region where, as before, you always maintain exactly the right ratio of supply to demand. So we have some graph that's showing that. So here in blue, I have this limited liability case, which I think is the realistic one. Basically, anytime you're to the right of this bubble point, you're going to remain here at the start point. So if you have a shock that's moving you a little bit on the left-hand side, A, this ratio, then you want to jump back so that you always remain there. From time to time, you're going to have a very large negative shock that's going to move you past this bubble point. Bubble point corresponds to the point where your equity goes to zero. And when that's the case, then the best thing you can do is just wait. You cannot do any repurchase anymore. Okay, I'm going to argue that this is actually consistent with what we see in the data with the Terra Luna crash. So Terra Luna, we see that indeed at the time where the price of Terra, the stablecoin, went down, was crashing, we also see a very large impact in the price of the Luna, this equity token. What we see when we look at the quantities of these two things, we see that indeed the platform was trying effectively to reduce the supply to match this attack on the platform. And by the way they were doing so is by creating more and more Luna tokens, and like using these Luna tokens to repurchase up to the point where the quantity of Luna, the price of Luna goes to zero, and the quantity of Luna basically reaches an asymptote. Like creating trillions and trillions of dollars, things that was zero, you cannot use that to repurchase. It doesn't work, and then the supply of Terra just plateaus, and then you see the price collapsing. Okay. I want to mention what's going on now if I reintroduce collateral into the picture. If I introduce collateral into the picture, that's going to help with respect to stability. The reason is that now you basically have more equity into the platform. Or another way of saying that, like now, in order to finance the repurchases, you can also use the collateral as an asset. So that's going to help you. But collateral is also going to be costly because you have this collateral carrying costs. The collateral already has these convenience yields. So it means it might not be privately optimal for a platform to fully collateralize the stablecoin scheme. And we actually have an existence condition for a fully collateralized platform as well, which basically tells you that it has to be larger than the convenience yields. Otherwise, it doesn't. Okay, so let me move to the overissuance problem. So until now, I assumed that you could write smart contracts on everything. The issue is that in practice, the quantity of stablecoin outstanding is going to be observed in the blockchain, but the demand is actually not. Because it's not, you might not be able to write a smart contract on that. So I'm going to give you the intuition of why we have this time consistency problem that you always want to overissue. The idea here is that issuance is going to be sequentially decided. So at any point in time, you will have to re-optimize. You have the option to re-optimize. So as compared to before, I'm going to at each point in time, it has to be that I want to re-maximize the value of my equity. Looking at the equation for the value of my equity here in the full collateralized case, so my size equal to 1, I find that my equity is the quantity of collateral that I have, exactly the same as the quantity of stablecoin on the asset side, plus the present value of all my singular revenues, minus the market value of my debt. So by increasing the quantity of stablecoin, you're going to decrease the price. And because you decrease the price, decrease something that's a liability for you. So that's actually going to increase the value of the platform X post. So that's going to create like very strong incentives, exactly like in the Trojan conjecture problem, for you to overissue X post. So it's time consistent. Okay, so the way you resolve this time consistency, that's what we have in the paper, it's not on the slides. You basically need to find a way for the platform to internalize its externality on the price for its orders. There are different ways you can do that, but one particularly interesting way is through decentralization. And with my 40 last seconds, I'm going to explain that. So now I'm going to move from a model where issuance is directly decided by the platform to a world where issuance is actually decided by decentralized entities. So we are going to have now a continuum of arbitrageurs, and these arbitrageurs will be able to lock some collateral assets and then create some stablecoin against this collateral asset in like some kind of vault or a virtual bank, if you want. Something is going to be important still is that the platform will still make some profits. The platform will make these profits now by charging fees on this arbitrage position. It's going to charge a flow of fees, ST, and it's still going to pay the final user, some interest rates. So it's going to make, at the end of the day, it's going to make a profit flow of ST minus delta T times the quantity of stablecoin outstanding. And this is going to change the fundamental incentives for the platform to maintain or to not to overissue. in the following way. So in a centralized platform, this time consistency problem is really coming from the issue that you're making your profit, your singular profits, anytime you create a new coin. And when you create a new coin, you sell effectively all of the future singular revenues going forward at once. And for that reason, you don't care about what's going to happen after that. Whereas if you have like not this decentralized setting, you're going to get your profit flows as proportionally to the quantity of stablecoin at any point in time. And for that reason, you're going to retain the right incentives to keep maximizing the quantity of the stablecoin. And that changes your incentives, and you're going to not overissue in this case. So let me leave you with my conclusion slide. We provide a framework to analyze the stability of stablecoin. We find that even if you have these full commitments, you may still get in trouble with large negative demand shocks because the platform is effectively leveraged. We find that collateral can improve the stability, but it might not be privately optimal to do it, and it does not mitigate the overissuance incentive. And we also find that decentralization can actually help you with this commitment. Okay, thank you.
Thanks very much for the opportunity to discuss this very interesting paper. It was a nice chance to get to know an area where I haven't worked myself. So let me begin with the motivation. So stable coins are cryptocurrencies that maintain pegs to official currencies. That's the rationale for stable coins. So they cater to investors' demand for alternative means of payment by combining the benefits of blockchain that allow commitment through smart contracts and the stability of traditional. Now, there's a wide range of cryptocurrency stablecoin protocols in reality, like algorithmic supply adjustments, Terra, partial collateralization, cracks, and decentralization of the issuance process. So the basic question, the overarching question the paper asks is, what are the relative advantages and disadvantages of the varying protocols? How is the stability of cryptocurrencies affected by varying levels of commitment to future interest rate policy, issuance, buyback policies, and collateral policies? How does the decentralization of cryptocurrency affect the overall stability of the market itself? And also related to that question is, what is the optimal cryptocurrency platform? So first, let me just briefly present an overview of the results before I frame my comments. So in the full commitment case, where the platform can commit to the interest rate policy, issuance repurchase, and the collateral policies, there's of course a trivial equilibrium with no stable coins, similar to an equilibrium with fiat money, because there's no external anchor as dividends that depend on stable coin value. So there is an equilibrium with zero value. But there's also an interesting non-trivial equilibrium in which the peg is maintained unless the demand is hit by a large negative shock. And that's very intuitive, because if there's a large negative shock, the cost of repurchasing stable coins to maintain the peg exceeds the post-repurchase equity value and violates limited liability. So in the model, the state variable, so in the model, the demand for stable coins is exogenous. So what is endogenous is the stock of stable. So the ratio of the stablecoin demand to stablecoin stock is the state variable. So if this ratio exceeds the threshold, then the platform intuitively is able to maintain the peg, provide a non-zero interest rate, and stablecoin holders enjoy a convenience yield that gives seniorage rents to the platform, and the equity value is positive and increasing in this ratio. But below this threshold, if there's a large negative shock, if this threshold goes below, then the stablecoin loses its peg. Right? The price is less than 1, and there's no interest rate. It's costly to provide interest to the stablecoin holders. Collateral is entirely used to repurchase stablecoins. Why? Because by repurchasing stablecoins, you lower the stablecoin stock. That increases the probability of returning to the target region where the platform can earn seniorage rates. And the equity value is 0. Now, what happens with collateralization? So if there's an uncollateralized platform, again, intuitively, there's a non-empty region where the peg is lost. But if there's a fully collateralized platform, then the peg is always maintained via collateral. Collateral is costly. So the equilibrium actually exists only if the convenience yield of stable coin exceeds the collateral holding. So the optimal platform, what does it do? It trades off the benefits of stability, liquidity benefits of stablecoin holders, senior rents to platform, against the costs of collateral. And in general, the authors show they cannot be analytically solved, but numerically, there's in general an interior solution. Now then they go to non-programmable issues. The platform can commit only to interest rate policy and a minimum collateral ratio. And stablecoin issuance and repurchase decisions and default decisions must be sequentially optimal in a Markov perfect. In the target region, where A is greater than this threshold, again, it's optimal to maintain a target demand stablecoin ratio that exceeds the ratio under full commitment. This equilibrium is actually sustained by off-equilibrium punishments of a very high interest rate if the peg is lost. There's a deviation. Again, these are very intuitive results. And then there's the purely algorithmic protocol with no collateral. It's optimal to liquidate as soon as the peg is lost to provide maximal incentives in the target region, because there's no other way. You have to provide the maximal incentives through this threat to liquidate. And in the fully collateralized case, it's optimal to set the interest rate so that the total return on stable coin equals the risk-free return. In other words, it's a stable asset. And then they go on to decentralized protocols. So any user holding eligible collateral can issue stable coins. Issuers must lock the collateral in vaults. The equity token holders charge vault fees and set interest rate policies sequentially. Here they show in the decentralized case that the equilibrium is equivalent to that of a centralized platform, full commitment and full collateralization. Okay, let me get to the comments. First off, very interesting and topical paper. I learned a lot from reading it. Very well executed, very well written. Some of the exposition can possibly be clarified a bit. The paths to the main results are sometimes obfuscated by technical preliminaries. Maybe some of that could be relegated to the appendix to get to the punchlines. And there's also various consideration of various cases, zero collateral, maximum collateral, and so on, can sometimes be confusing. And this one, yeah, too many footnotes. It create a bunch of distractions while reading the paper. So you could probably economize the footnotes. Okay, now some substantive comments. So as I was reading this, I was asking myself, why do stable coins exist in this model? So in the model, users demand stable coins because of this liquidity convenience yield, but demand is exogenous. Now, isn't there a currency or a safe asset that also provides at least the same convenience yield? So why can't users hold the safe asset directly? Presumably, it's assumed that they cannot access the same. So if you look at the portfolio problem of stablecoin holders, it's unclear why there would be non-zero allocation to the purchase of stablecoins, because price is not allowed to exceed one, it can only be one or below one. And in fact, if you look at the full collateral equilibrium, PEG is always maintained, stablecoin is a safe asset, exists if and only if the liquidity yield is at least as great as the collateral asset, as the collateral cost. So it's basically isomorphic to directly holding the safe asset. So what ends up happening is you synthetically replicate the safe asset. So that, and I'm going to revisit this point. Second thing is related to the stablecoin liquidity convenience yield. So model assumes that the convenience yield is zero if the stablecoin price deviates from par in either direction. So it's understandable why the yield would decline if the stablecoin price falls below par, but it was less clear why the yield is lost if the price exceeds par. So this yield is actually related to liquidity. So why is liquidity hampered if the price exceeds par? So now the reason I bring this point up is allowing the price to exceed par could actually justify stablecoin issuance in the full equilibrium related to the earlier comment. But then there would be a non-zero demand for risky stablecoins that provide a risk premium relative to the safe asset. So that could potentially create that non-zero demand. Now, what about so the model assumes that the product of the convenience yield and the value of stable coins is single peak to ensure the existence of an interior optimal solution. But it's nice to provide more independent justification beyond the technical justification. With a large supply of stable coin, one would expect the convenience yield to actually increase because of strong network effects. So the notion of liquidity implies that one would expect it to increase as the stock of stable coins increases. So I was sort of this assumption maybe requires some more justification. The model assumes that the platform holds a safe asset as collateral. It earns a return that's lower than the risk-free return, and the wedge is due to the convenience yield of the collateral asset. But if all holders of the collateral asset earn the convenience yield, then why doesn't the platform also realize it? So the explanation in the paper is that the asset is used as the collateral. That's why it foregoes the convenience yield. But it's unclear why that would be the case, because collateral purchases and sales accompany changes in stablecoin stock to maintain that fixed collateral ratio. So the liquidity actually matters for these transactions. So it wasn't clear why the platform would forego this convenience yield, and that's crucial because that's where the cost of collateral comes from. Now, regarding collateral again, why can't the platform directly hold a safe asset that earns the risk-free return? So if there is no such asset traded, how do we interpret the risk-free rate in this model? So in the model, the collateral cost, as I said, is solely due to the platform not earning the convenience yield. An alternative approach could be that the platform forgoes profitable investment opportunities because it must hold collateral. And one source of collateral costs, this is the typical source in intermediation context. Another source could be fire sale externalities, but that's harder to incorporate in this framework. So it's very messy to do. Now, again, with regard to the interest policy, the model assumes that interest payments are made in stable coins rather than dollars, or the safe asset. So this actually increases stablecoin stock without compensation for the platform. So it's unclear why this is optimal in this framework, because the platform is then forced to trade costly collateral to maintain this fixed collateral ratio. The justification given in the paper is that this is the policy in practice, but why is that the case? It'd be nice to justify this endogenously within the framework. Again, some of this stuff may be difficult to do. I just thought it might be worth commenting. Now, regarding collateral policy, the model assumes that in all protocols, the platform commits to a fixed collateral ratio. Again, it's not clear why this is optimal, especially given the earlier assumptions regarding collateral costs and interest policy. So it's important for tractability. It avoids the level of collateral as another state variable, but it has potentially major impact and implications. The paper comments that the platform would maintain this fixed collateral policy, which was subject to a minimum collateral ratio, but holding collateral above the minimum requirement is suboptimal. The paper mentions that in a footnote. This strongly suggests that a fixed collateral policy is in fact strictly suboptimal, as we would intuitively expect. So I realize that's not tractable, but could you potentially solve the model with a dynamic collateral policy numerically to check the robustness or see how it changes? That would be an interesting exercise. Limited commitment. So section 4 considers the intermediate case of the platform to commit to collateral interest policy, not the repurchase issuance of stablecoins. It's unclear why it would be easier with the platform to commit to the former but not the latter. Given the earlier comments, it's potentially more interesting and plausible that the platform commits to the collateral policy, but not to the interest policy and repurchase issuance. So this is what is actually assumed in the analysis of decentralized protocols. And more broadly, what are the significant additional insights from this intermediate case? If it's not, it might be worth focusing on the full commitment and decentralized cases, perhaps trace this analysis in the appendix. Now, again, going back to stablecoin demand, in this model, as I said, stablecoin demand evolves exogenously subject to negative shocks due to and this is because of tractability. The optimal platform trades off these rents against collateral costs. But I was thinking of an alternate story where stablecoin demand could be driven by real consumption risk due to an unstable currency, for example, the Argentine peso, and a platform provides insurance via stablecoin. So it's isomorphic to a standard capital structure framework. There's fixed liability due to a peg, and the collateral is risk. So this is sort of an alternate story that I thought might be relevant. So the paper motivates by observing there's a variety of protocols. Framework is ideally suited to answer this question. Why is there this variety? If there's an optimal platform, why does such a big variety exist? What are the sources of variation that can explain these? Be a nice question to answer. I'm out of time. So excellent paper. That is a very interesting and topical question. Elegant model, well-executed analysis. Maybe you could probe the modeling assumptions a little further, and you can use the framework to explain the existence of widely varying protocols. Please do read the book.